For more than a year, most economists, me included, have expected the U.S. to fall into a recession, but that hasn't happened. In fact, it was just reported that the economy grew by a very strong 4.9% in the third quarter. In this video, we're going to look at a series of leading economic indicators that have been reliable in predicting previous recessions. We'll find that over the last year to year and a half, these leading indicators have been misleading in that they have pointed to a recession that hasn't occurred. We'll also look to see what they're currently suggesting about economic growth during the months ahead. This chart shows real gross domestic product at seasonally adjusted annual rates from 2021 to the third quarter of this year. Economic growth was strong during 2021. It then contracted during the first half of 2022. From mid-2022 to mid-2023, it was at or above trend growth. And in the most recent quarter, the third quarter, it was very strong again. Normally, the economy is said to be in recession when GDP contracts for 2 consecutive quarters, as it did in the first half of 2022. However, the National Bureau of Economic Research, which is officially responsible for deciding when recessions occur, did not conclude that the U.S. was in recession in the first half of 2022. So there's been no recession. We're going to look at 14 leading economic indicators that provide important insights into nearly all the major parts of the economy, including the financial markets, manufacturing, the housing sector, employment, and credit. We'll start with the Conference Board's leading economic index. Each month, the Conference Board releases its leading economic index. The LEI is a composite index of 10 economic indicators that are designed to predict the direction of the economy in the next 3 to 6 months. It has a proven track record of predicting recessions, and it's one of the most accurate leading economic indicators available. Therefore, is closely watched by economists and investors. This index peaked in December 2021. It's fallen nearly every month since then. When this index declines, it means that a recession is increasingly likely. And as this chart shows, the string of monthly declines in this index has been one of the longest, going back to 1959. Despite this, the U.S. hasn't fallen into recession. So this leading indicator sent a misleading signal in 2022 and thus far in 2023. Now the financial markets. The yield curve is said to be inverted when short-term bond yields are higher than long-term bond yields. Typically, the opposite is true because long-term bond yields face greater risk than short-term.